Inflation rate was up 8.3% this year, and in response, the Federal Reserve increased interest rates by 0.75%, which is the fifth hike of the year. However, financial expert and ARK Invest CEO Cathie Wood believes that the FED may be making big mistakes by tackling inflation in this way, adding that the institution may be overlooking some important data in the process. Hey guys, and welcome back to Everything Tesla Stock. The FED has constantly stated that it's dedicated to lowering inflation rates as much as it can. The US Central Bank recently announced a third consecutive 0.75% point rate hike, bringing interest rates to a range of 3 to 3.25%, the highest they've been since 2008. Although interest rate increases typically come in 25 basis point increments, the FED seems to be taking drastic action to reduce the inflation rate, which is well above its benchmark target of 2%. Reacting to the news, Wood has stated that while the FED may see this as an effective means of combating inflation, the results of this action may have serious detrimental effects on the economy. Why has Cathie Wood said this, and what are the possible effects of this hike in interest rate by the FED? Keep watching to find out, but before we get into it, don't forget to like and subscribe, and turn on notifications to keep up to date on everything going on with Tesla. By increasing interest rate, the central bank plans to discourage spending, which can reduce inflation on the prices of goods and services. But actually, there are other consequences to this, like an increase in home equity loans to up to 8% and a possible increase in monthly payments for new mortgages, or ones with variable rates. Although Wood believes that the economy is plunging significantly due to inflation, the financial expert also believes that companies are also likely to suffer the hit of deflation. And this is a problem for investors to be worried about. No doubt inflation is hitting hard on the economy, but this time it's not as a result of the usual causative factors, but rather a product of major economic shocks that have never been seen before. Unlike in previous times where factors like the crash in dollar value and oil prices caused inflation rates to spike, the case is quite different now, as issues like the pandemic, the supply chain problem, and the Russian-Ukraine war are all major contributors to inflation. This is not the first time Wood is revealing her concerns about deflation. When she previously spoke about the subject, she claimed that 50% of the S&P 500 is at risk of creative destruction, and most companies, especially automakers, are unprepared for the effects of deflation. Wood added that automakers could suffer bad deflation, as well as commodity deflation if proper steps are not taken. In 2021, the stock investor warned that deflation rather than inflation will be the largest risk for financial markets and the economy in the coming years. Wood stated that she expects the US economy to grow less than many economists expected in the year ahead. Although the FED is basically concerned about reducing inflation, well, there may be some overlooking factors in the process of lowering inflation. Deflation may set in, and according to Wood, there are several indexes to show that deflation is gradually setting into the system. One such is the used car index. The Mannheim Used Vehicle Value Index declined to 204.5, and the year-over-year value is now down 0.1% from 54% about a year ago. According to the report, wholesale used vehicle prices decreased by 3% in September from August. It estimates that used car retail sales declined 8% in September from August and were down 10% year over year. According to Wood, the assumption about the residual value of cars is rather on the high side, and most people bought cars with the hope that the used car price index will keep going up, allowing them to sell these cars at a fairly high rate. But this did not turn out to be the case. People may be buying less used internal combustion engine vehicles, not because there is more production of these cars, but because they're becoming increasingly difficult to maintain. But on the bright side, while it could be a bad market for the ICE car market, it might be an opportunity for electric vehicles to take over, since they're becoming easier to maintain, and there are new policies to promote these vehicles. Also, judging by Wood's previous discussion on inflation, innovation may be the saving factor for EV companies. Wood stated that automakers are likely to struggle following the creative destruction caused by inflation, adding that companies that are running their shares in the short term with less investment in innovation may find it difficult to keep up with the coming market challenge. Likewise, automakers with products that can become obsolete will also have to sell these commodities at a discounted rate or risk incurring a massive loss. In the commodity deflation where inventories are surpassing demand, car companies may have to sell their cars at lower prices to cover the cost of production. Cathie Wood believes that only companies with competitive edge in innovation can thrive amidst the expected deflation. She expects that the decreased economic growth will prompt a shift to the type of companies that can grow regardless of economic backdrop. This is likely where Tesla bulls will heave a sigh of relief, since Tesla has been impressive in terms of innovation. Do you think the same? Let us know down below, and don't forget to leave a like on the video and subscribe if you haven't done so already. Although FED claims that its strategy is sensitive to data, that is not what most financial experts like Cathie Wood believe. Paul Nault, portfolio manager at Kingsview Investment Management, Chicago, stated that the FED commentary was pretty hawkish, adding that the rise in price is an indication that the markets are volatile and will see a much higher chance of recession over the coming 12 months. Also, Ryan Detrick, chief market strategist at Carson Group Omaha, said, "It was a rather hawkish 75 basis point hike, and the FED left the door wide open for even more rate hikes before the end of the year. The dot plots confirm more hikes are coming than were expected, and the FED is willing to produce a good deal of pain to the economy and potentially to the stock market in order to rein in the runaway inflation that we've seen this year." According to Detrick, the economy expectations from the FED are quite disappointing, and the economy is slowing quickly. He added that the FED's stance on interest rates could cause the dollar to move higher, pressuring stocks once again. On the other hand, the FED does not seem to be giving up on its quest for power anytime soon. According to Federal Reserve Chairman Jerome Powell, the institution is bent on keeping its stance until it is sure that inflation rates are going down. He said inflation is running too high. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningful restrictive stance on policy and staying there until we feel confident that inflation is coming down. Also, several FED officials have said that they need to see sequential months of inflation moving towards 2% before there can be any discussion on easing the policy. San Francisco FED President Mary Daly spoke about this in a recent interview with Bloomberg News. She stated that there will be more policy adjustments required to restrain the economy sufficiently, and she sees the FED raising rates to that level that she believes is restrictive enough to bring inflation down, and then holding it there. While the FED's current target range for its benchmark rate is 3% to 3.25%, it is still working towards a goal of quickly raising its benchmark interest rates to around 4.5%. Several officials have also said it's going to take a lot to push them off this path, and the FED is prepared to go higher if the elevated inflation rates fail to show signs of easing after this. FED Governor Christopher Waller confirmed this, stating, "Until we see any signs of inflation beginning to moderate, I don't know how we pause." While there is a lot of optimism that inflation is gradually easing, FED doesn't seem to be anywhere close to backing out of its plans, even with the risk of a downturn in the economy. The US Central Bank could be on a course to deliver a fourth straight 75 basis point rate increase in the future. While the consequence of this move by the FED may not be so evident at the moment, but Cathie Wood believes that it will be eventually. Although this may not only affect the United States but other countries as well. What do you think about the comments? Do you think the FED is making a mistake by increasing interest rates to combat the rising inflation? Let us know down below. And if you'd like to know what Tesla's been up to in the last few days, go ahead and click on this next video on your screen. See you there.